Cryptocurrency taxation varies by country. In Nigeria, cryptocurrencies are not officially taxable since the country itself banned banks connecting with cryptocurrency exchanges. However, in the US, India, Canada, and other countries, cryptocurrencies are subject to taxation. Now, let's see how crypto is taxed in US. In the US, people who have cryptocurrency needs to pay tax to the IRS, that is the Internal Revenue Service. It is a federal agency responsible for collecting federal taxes and enforcing US tax laws. The IRS treats cryptocurrency like a property, so any money you make or lose from buying and selling cryptocurrency is taxed like gain or losses. For example, when you buy land, its value increases or decreases over time. If you decide to sell the land later at a higher price, you'll have a gain, so you will pay tax on that gain. In the same way, when you buy and later sell or exchange a cryptocurrency at a profit, you've made a capital gain. So like paying taxes on the profit from selling lands, you must also report and pay taxes on your crypto gains. However, not all crypto activities are taxable. The crypto activities that trigger taxes include selling crypto for fiat or converting it to another crypto, paying for goods and services with crypto, receiving crypto as payment, crypto mining, staking, and similar crypto incentives. On the other hand, you don't have to pay taxes on crypto if you simply buy it and hold it, make a crypto donation, receive or send it as a gift, or transfer it to another wallet you own. Let's talk about how to calculate your crypto taxes. There are two ways this is done. One is capital gain or loss, two is income gain. Let's start with the capital gain or loss. The capital gain is the difference between the sales price and the cost price. The cost price basis is simply the amount you pay to buy the crypto. If you bought BTC at $19,000, that is your cost basis, and you sold at $30,000, that is your selling price, which nets you a profit of $11,000. This $11,000 is your capital gain, and you have to pay tax on it. But assuming you bought Bitcoin at $30,000 and sold at $19,000, that is a capital loss of $11,000. No taxes will be paid on the whole $11,000. The IRS permits you to pay taxes only on $3,000 of capital loss from your capital gain each year. Anything remaining, in this case $8,000, is carried over to the next year. Now let's look at income gain. The crypto you earn from mining, staking, and other crypto incentives are subject to income tax. The amount of tax you owe on them depends on their value on the day you receive them. For example, let's say you earn 10 coins from mining and each coin was worth $50 on the day you received them. You will need to include $500, that is 10 coins times 50, as part of your taxable income for that year. But here is the thing. If the value of those coins increases after you receive them, you also owe capital gain tax when you sell them. On the flip side, if the value drops, that is when the capital loss tax comes into play. Now, let's talk about tax rates. The tax rates you will pay largely depend on your income tax bracket, which is determined by how much you make in a year. Now, the IRS uses a progressive tax system, meaning that the higher your income, the higher your tax rate. For example, if you make up to $50,000 a year, you are in the 22% income tax bracket. But there's a way to pay less tax, and that's where short-term and long-term tax comes in. If you sell your crypto within a year, you pay a short-term capital gain of 22%. However, if you hold it for more than a year, you will pay a long-term capital gain tax of 15%, assuming you are still in the $50,000 income tax bracket. This means that you can choose to hold onto your crypto for a year before selling it or get a lower tax rate, but that's only advisable if you are in a losing position. But then, this pertains to the US alone. Other countries differ. India uses a flat 30% crypto tax, South Korea 20%, and Canada taxes crypto differently depending on how long you hold it. It is your responsibility to pay taxes on your crypto profits, Major exchanges like Binance and Coinbase report your trading activities to the IRS, so there is no way to evade these taxes. You can use the capital gain report provided by these exchanges to calculate your taxes, but if you would rather save time and energy, you can hire a company to do this or use the tool that I will leave the link in the description. The good thing about crypto tax is that it helps to generate revenue for the government in a number of ways. For example, India's new 30% tax on crypto income is expected to generate around $30 billion in revenue over the next 4 years. This revenue will be used to fund important government programs such as healthcare and education and improve the overall economy of the country. I believe this is something that could even benefit the anti-crypto countries if they should queue in. And of course, there are also some potential drawbacks to this, such as the risk of driving away cryptocurrency businesses and investors if the tax becomes too burdensome for them to handle. However, if this is handled properly, I believe the benefit of crypto tax outweighs the drawback and can potentially lead to increase in the adoption of cryptocurrency. If you're in Nigeria, you don't have to worry about all this for now. If you want to learn how to trade cryptocurrencies profitably and learn more about cryptocurrency and DeFi, then create a Bybit account and join my group. All links are in the description. I'll see you in that group and in the next video.